What is up, y'all? Proof of Workforce Live. 12 months ago, a Bitcoin prediction out of MIT. We have turbulence in the public pension system, and we'll catch up hearing from Parker Lewis on 3 things that he thinks could lead to Bitcoin being used as money. Punch your time cards. This is where workers and wage earners come to grab Bitcoin signal. Let's jump right into Jesse Myers, 12 months ago at MIT, making a prediction about the halving cycle and where Bitcoin might land today.
Because people are excited. Why is the price of Bitcoin, why does it keep going up for the last 6 months? I want in on that. It's going to keep going up. I want to buy more. So now you're suddenly eating bigger chunks. Granted, you're also starting to inspire some long-term hodlers to start selling some supply. But this starts to accelerate. The imbalance starts to accelerate. And now you've really reached mania conditions where you're chewing through available for sale supply because of the imbalance of demand versus supply from mining and supply from hodlers becoming willing to sell.
Okay, so that was 12 months ago, the day after the halving. Chris Alamo, get in here. I don't know. These institutions. There's some pretty smart folks, right? Massachusetts Institute of Technology. Jesse's an MBA from Stanford. They are talking about the halving cycle, and what he's saying basically from that clip is things are just heating up right now. That was 12 months ago to this date. The slide, 12 months he had on there. This is when supply really starts getting crunched and people really start tuning into Bitcoin and things start taking off. What are your thoughts?
It's the age-old debate of if the halving affects supply. You're like, is it priced in or is it not priced in? A lot of people say it is priced in. That's why, we have these 4-year cycles is why it gaps up. But then a lot of people say it's not priced in because if you know this, you'd be like Michael Saylor and trying to get your hands on as much of it as possible. I think, it really comes down to, I hate to break it down so simply, but it's basically supply and demand economics that basically, as the price starts going up, a bunch of people are selling because they're long-term holders or they've been holding for a while. They're getting out, cashing into fiat or into other assets. Or, let's just say that you're holding on and as supply is being eaten up, if demand remains the same and supply is cut in half, once you eat through the lot of sellers or the people that are basically locking in their gains, whether it's hedge funds, whether it's long-term holders, whether it's, Bitcoiners that have held it for a long time, they have to buy things, once you eat through that and demand is staying the same or going up, price has to reflect that eventually. And, obviously Bitcoin's, there's a great saying by Greg Foss that says you sell what you can, not what you want. So a lot of times Bitcoin's liquid 24/7, 365, the stock market is, closed more than it's open throughout the course of the year. So, a lot of times if you're getting margin called or if you have like option contracts or things that are even like, I know there's like these crypto contracts and stuff like that. Well, you can do that with Bitcoin that, it's pay on demand. If you hit the strike price, it's not like traditional brokerage accounts where you have 48 hours to get money into the account or a week to get money in the account. It's if it hits this price, it's going to get liquidated. It goes to the person that's on the other side of the counterparty of the contract. So I do think cycles are not dead. There's been talks they're dead. They're not dead. It's a super cycle. I do think the 4-year cycles are still on. And if history repeats itself, it's normally 12 to 18 months. So I kind of agree with Jesse Myers here that, the next 6 months, I think things are going to get crazy. What are your thoughts on Dom?
Impeccable timing from Jesse, right? I mean, 12 months ago to the date. Obviously today and over the weekend, we saw a significant run up in Bitcoin. We talk about this all the time, Alemo, price, right? Like, some of the strongest, most convicted holders in any industry on the planet Earth. And, that conviction to hold, right, has carried Bitcoin into now being, I just looked, it may have already passed. I'll look right now, but we were just inching up again on passing silver as the 7th largest or most valuable asset by market cap in the world. So we'll double check that. As far as like top assets, I'll see if that's if that passed right now. But yeah, interesting from Jesse, and he had a really good talk. That was from Bitcoin MIT Bitcoin Expo 2024. And Jacob, I don't know if you have his original post, but the crowd It's not quite putting out, like, a little bit empty there, Alemo. I'm just saying, like, not the hottest class at MIT right now. I'm seeing like 50%, maybe 40% attendance there at best.
It's given Andres Antonopoulos vibes from like 2013, his conference in, I believe, either San Fran or something like that, with like 12 people in the room. So I guess we've 4x'd in the number of people listening to Bitcoin talks in prestigious universities, but still not a poppin' crowd as you'd think.
Yeah, and just for that info on the market cap, sitting at 91,457 right now. Bitcoin has a market cap of 1.815 trillion, and silver is at 1.827. So it is right on the heels of silver, which has been around for a long time. That's the 7 and 8 most valuable assets on planet Earth right now. Coming in at 9 is Saudi Aramco, followed by Meta and Berkshire Hathaway, some other names that you know. Okay, moving on. Here's an interesting, we track pensions a lot, and there's been a lot of pension turmoil. We saw last week that the largest pension in the United States, CalPERS, had a $26 billion markdown in its portfolio. Well, a study report came out today that public pension funding ratios dipped below 80%. So your average funding ratio for local and state pension funds throughout the nation falling below 80%. Chris, what's interesting is that it's taken almost a decade to get back to over 80%. That was a huge milestone. Some people say that the milestone of 80% as a healthy funded pension is kind of like overblown. It's kind of like over referenced. Others say it has value. Either way, it is important for pension funds to stay close to their target funded status. And for those at home that don't quite understand what that means, it means that at 80%, a pension fund has 80% of all the assets it needs to fulfill its obligation to all of the retirees over the years. So, thoughts on that, Chris, on just, it seems like the public pensions are definitely feeling the tariff turmoil over the last few months, and we're starting to see funded ratios go down, as of late.
Yeah, I mean, I love hitting the general numbers. Like we always say, like above 90, 90 and above is good. 70 is like not great, like average to below average. Obviously, if like 80% is kind of that mark. And then as you always say, the magic number is 40%. If you get to 40%, it's basically like a sunk ship, game over, we're dead in the water. It's not going to happen. And ultimately that affects the everyday earner, salary retiree, that like their pension's defunct and they're not going to be able to get paid out in retirement or get help in retirement through their pension funds. So obviously, seeing them go down, like I said, sub 80 is kind of like, I can say 80 is okay, not great, not good. Like 90 and above is good,
That's
but
that's an old benchmark.
Yeah, but it's not good to see. Obviously, pensions are very tough because it's like one of those things. It's like you sell what you need, not what you can or what you want. So a lot of times, it's kind of like you're dealing with inflows and outflows. Obviously, you have assets and liabilities. Assets are money coming in or cash flow coming in, as well as assets on the books of the pension. While liabilities are people that you need to pay out or future payouts that you need to do. So I do think that they need, like, I hate to say they have to take bold calls, but it's kind of one of those things. It's like, well, we can't afford a 30% drawdown. And, as a lot of people say in this industry, if you can't handle the volatility, doesn't mean it's a bad asset. You just need to do a portion size or adjust for the size that you need. But I think pension funds are kind of in dire straits that, like, they probably need an allotment of Bitcoin percentage that's probably higher than what a lot of the managers that would be risking their career on. But at the same time, it needs to be like, they don't want to take a huge risk of like 50%. We can't deal with that kind of volatility. But like, let's just say they were comfortable with 1 or 2%, maybe 5% would be better for a pension fund, obviously. I don't know what your thoughts on that, Dom.
Well, yeah, 5% would be that would be one of its most aggressive holdings. So, how my thoughts are always like, you start with these things very small. The real issue here, I think, there's bigger issues. Forget about the allocations. There's incentive issues within the pension funds, right? Where whether the investment team or the CIOs of these pension funds are truly incentivized for the fund to perform well. And then you have the structure of pensions where, look, pensions were created to be these stable, slow-moving ships. They really were never created to close the gap on 10, 20% gains and take these massive risks. But You see pensions after the financial crisis. It all comes back to the financial crisis. The average funded pension in the United States before the financial crisis was in the low to mid 90s, very healthy. After that, it was wrecked to below 80, a lot of them in the 70s. Tons of pensions were in the 60s. Ones that were already in dire straits got knocked down to the 50s, the 40s, right? You think about the Illinois, Chicago, Dallas, huge problems there, especially with real estate and their holdings. So what happens is when a pension is underfunded, the cities have to fit the bill. And Chris, we have a very interesting dynamic where June 30th is the reporting date for pensions throughout the US. And if they are funded below a level that they expected, the cities and taxpayers will have to foot the bill. And then you start seeing things like pension reform where workers have to retire later or they have to contribute more into the pension. In reality, you know how I feel about this, and I'm running for the board. We have to fix the incentives of our pensions and the structure. You bring up a good point with Bitcoin in that the financial landscape has changed, and the traditional ways of keeping pace with liabilities and higher inflation, it's just changed. And so we really have to take a hard look and see how we're going to pivot. And we can go on forever on that. But I want to shift real quick to a place you just got back from, China. There was an article that came out called Inside China's Quiet Pension Funding Crisis. And ultimately, what the article said was that 40% of China's gig working economy was opting out of paying into the pension. And it's created a lot of problems for the pension to pay its current retirees. And if you look into the pension in China, they're moving money from wealthier provinces to less wealthy provinces to fit the bill and make these payments, because these payments come and you have to pay the retirees. And so it makes me think of Alemo. We hear Bitcoin is often accused of being a Ponzi scheme. But when you look up the definition of a Ponzi scheme, it says a Ponzi scheme is, a fund that lacks any, real solid investments or value that can generate a return. And it's where early investors are paid off by new, fresh investors bringing new capital. And once that new capital wears off, your early investors, all of a sudden the rug gets pulled out from them, right? And they realize, oh my gosh, like I put all this money in and now I'm not getting paid anymore. And the fund collapse and people go to jail if there's foul play and all that stuff. I don't know, like this, what are we reading about China's pension? We're reading that new, fresh capital is opting out. They're saying, no, thank you. We don't want to put our money into a pension fund that's potentially not going to be there. I'd rather buy groceries or buy something immediately that I need. And the pension now is showing cracks and struggling. Sounds very similar to the definition of a Ponzi scheme.
Yeah, no, I agree. Dom, we were saying before we went live that basically you can say the US stock market, the US bond market, the US housing market, China's housing market, China's stock market, they're all closer to Ponzi schemes than Bitcoin. We're all about power for the workers, power for the hourly worker here, and the wage earner. And basically, I think the closer you can get to having withholding, having the money yourself, operating it yourself, the better off you are. There's obviously caveats and risks that come with that, but like having Bitcoin in cold storage or having Bitcoin that you can control is much better. And then one extension away from that is the IRAs or the 401ks or the HSAs. Then an extension away from that is pensions. And yes, they're great. And then an extension away from that is Social Security. It's like the further you get away from it being that you and your family can make your decisions, obviously there's things that you can do. You can join the pension board like Dom, I hope you're doing. And, I will advocate for you, even though I'm not a California resident. But you can tell them or pitch them ideas for what they should invest in. But the further away you are from making decisions yourself, or the more restrictions you have on investment, the more likely chance of it going wrong or going awry. And there's not really much that you can do with Bitcoin. If you have it in cold storage, yeah, there's going to be extreme fluctuations. We can guarantee that to the upside and to the downside, basically. Not guarantee, but basically we've historically seen that you're more in control of it, but you can't control the price. But obviously there's things that you can do with it. You can lend against it. You can borrow against it. There's more optionality with it, where like a 401k, you can only get if you're 59 and a half, or there's all these restrictions that come with that basically.
Well, here's what's so interesting, Chris. And I talked to a group of retirees last week. The biggest thing with a Ponzi scheme, just think of the traditional Ponzi scheme, right? Where um, uh, I open a fund and I say we're going to invest in some mine somewhere or some technological place in Iowa. You don't know anything. You hand me a bunch of money. You don't know what we have. We maybe don't have really anything, and to keep this Ponzi scheme going, I need to get the next person to come give money, and I give you their money. But really, in reality, we never hold this investment. So, in reality, the key to determining if something's a Ponzi scheme or not is transparency. Transparency is very important. If you know that we have 10 acres of farmland in Iowa, if the farmland doesn't do well, that's not a Ponzi scheme. That's called a failed investment. If we don't ever have any farmland in Iowa and I'm just using money from Peter to pay Paul, that's a Ponzi scheme. We know that Bitcoin's incredibly transparent because of its on-chain metrics and the ability to audit in real time. And so it does not qualify. For those at home listening, Bitcoin does not fit the definition of a Ponzi scheme. Sorry, bad news. You've been kind of brainwashed by mainstream media that hasn't done their research. Now, pensions, if they're transparent in what they hold, they also would not be a Ponzi scheme. But a lot of pensions are holding a lot more private equity. And I will say, Chris, private equity is a much more ambiguous, less transparent field where you hand money to a firm. The firm says we're going to invest in this, and that, but we need to, we don't fit quite the mold of like the public stocks, and we'll generate a return for you. So that is something to keep an eye on with pension funds. And it all comes down to transparency. Participants of a pension deserve to know exactly what their fund is holding without ambiguity, without any mystery. And I'll just say, I don't know. Look, I'm not people have to decide for themselves if Bitcoin was right for their pension or not. But I will say that you can easily tell. Take the country of El Salvador and everyone's criticisms of what they're doing. They publish their on-chain data, and you can see how much they're holding at any given time in any given moment. And that does not fit the definition of Ponzi scheme. So I'm happy we put that to bed, because it's one of those New York Times like headlines that people just grab onto because they think that old Bitcoin holders are waiting for new holders, and that's the only way you make money. They don't know that Bitcoiners hold Bitcoin indefinitely, and that's proven by the on-chain metrics. What is it, Alemo, that 50-60% of the Bitcoin hasn't moved in years? It hasn't moved. No one sold it, and that includes when Bitcoin hit its new all-time high. So that also doesn't fit the definition of a Ponzi scheme when you have a new all-time high and people aren't selling onto selling what they hold. So really interesting stuff. The last thing, I know we're hitting pensions hard. I apologize to the poor worker at home that's just like, enough of this. But there was an article that came out that just said that corporate pensions are up. They are strongly funded for 2024. So the only thing I'll say about that and into 2025, Alemo, is you're gonna hear a lot of stuff on the tariffs are the problem, but then why are corporate private pensions doing better than public pensions? It's interesting. Thoughts on that?
I mean, if I had to guess, I know that, and this is only speaking from what I've seen on Wall Street, a lot of hedge funds saw uncertainty, obviously, in like right after the election. Things were good, stock market was going up. Then we kind of saw February, March, and even a little bit at the beginning of April that things were going down. The stock market was going down, the bond market was going up because everyone was flight to safety. So they thought bonds are the risk-free asset. They're flighting there. A lot of hedge funds or even people on Wall Street are think, oh, things are going to keep continuing to tank. So they're going to load up on bonds, and they're going to also tack on leverage to get more gains because the bonds are not giving that much. And then in the event that the bond market keeps going down, interest rates drop, or Jerome Powell has to drop interest rates, the bonds that they've locked in at 4, 5, 6% on their coupons, when the rates go down, you can sell those for a profit. So if you paid $100, but then the interest rates drop, you have $100 bond that's paying 4 or 5%. When interest rates drop to 3%, you can get a yield on the value of the bond. It's very confusing, but you can look it up. There's many great YouTube videos there. The point being, a lot of these hedge funds and Wall Street people levered up on bonds in March and April. And then we saw the reverse happen. Gold started going up. The stock market started going up. Bitcoin, we've seen this rally. So basically, all these things reversed. And then the bond market yields or interest rate went up, meaning that people are selling bonds. So the interest rates have to go up to incentivize investors to go back into bonds. So a lot of people are selling bonds, going into riskier assets because they're getting better returns. On top of that, there's a cascading effect that people that had leverage get force sold into bonds. So then the interest rates keep going higher to try and incentivize more people to go in, while hedge funds are getting, I hate to say blown up, but like they're like losing a ton of money. So basically, I think a lot of the ones that didn't do well were positioned to not be in bonds because they learned from the lessons of 2023 when Jerome Powell's like, we're not even thinking about raising interest rates.
Oh yeah,
And then they
pensions took
and they
big hits on that.
yeah, so then they raised interest rates at the fastest clip they've ever seen in history in 2023. So I think a lot of people were positioned like, hey, if we have bonds, we're going to like much smaller allocation and no leverage, versus some people that are like, if we need to have bonds because of our mandate, let's leverage this position up because we think Trump's going to destroy the economy. You know, you could believe that or not believe that, but the markets respond that that's not exactly what happened, and that caused a lot more people to lose money. So if I had to suspect, that's just me speculating, but if I had to guess, I think a lot of these funds are required to hold bonds, and either they leveraged up or they took on more risks than they were expecting in bonds that they thought there were going to be better returns. I don't know. That's just my theory, but I think that a lot of the private pensions are like took that risk away, where maybe more of the public fund were like, hey, we still want to be allocated to bonds, and if the stock market crashes, we'll do very, very well in 2025. But that's just my thoughts. What are your thoughts on that, Dom?
Yeah, I mean, yeah, you also have a lot of these larger top performers. They're overfunded, some of these private pensions. There's two things. Number one, they can shut off the water faucet for retirees at any time. We saw that at like Kodak, where they just said, sorry, what we said we'd give you, we're not going to give you anymore. So they can control their liabilities. Number one, they can freeze. Some of these pensions have been frozen. Number two, if you look at the top names of the top corporate private pensions that are overfunded in numbers as high as like 180% funded status, they also are closest to, the inner table of how money works.
The
JP
money
Morgan is
printer.
one of those. Yeah, I mean, like they know where the deck's going to get shuffled, where the cards, where the chips are going to land, whatever saying you want to throw out there. But
The
ultimately,
cotillionnairs, my
yeah,
favorite word.
they
The
know
money
how
printer.
things are going to end up. So I think that it's interesting, and we'll see what funds do well. And it's also another indication that your investment team matters. Whatever your fund is, your investment team matters during these times. I know we're pushing the boundaries of the work break. We got a quick clip from Parker Lewis, who we caught up from, who kind of went through. We're going to shift gears here. At BitBlock Boom, we were talking about Bitcoin is money. We've been talking about the asset to death here, but Bitcoin is money. Parker just touched on three things happening that he sees as facilitating or accelerating use of Bitcoin as money. Let's hear from Parker.
See one merchant doing it and they understand Bitcoin, they want that for their business. So it's the fundamental of the finite supply leading to the most efficient way to get it. It's the censorship and the friction of the legacy system, and then it's seeing others go before people and leading by example.
Love it. And many of those happen in some form already. And so people just have to look and open their eyes to that. So Parker, dude, I could go on forever. Love what you're doing at Zaprite. We've worked together a lot on a bunch of stuff. We could go on forever, and we will go on forever, right? So Chris, right there, starting off, getting off a zero, right? Just starting by accepting a transaction and seeing that it is something doable. He mentions the friction and censorship of the traditional system, and that could be something as payment, processor saying, sorry, you can't do this transaction, or saying, hey, it's going to cost you this much money to move your money this day, or we'll do it for free next week. And then the third thing being, as people see others accepting Bitcoin or using it, that he feels will accelerate Bitcoin as a currency. Real quick, what do you think as far as, do you agree, or what do you see as things that kind of make Bitcoin serve or more deeply fulfill its kind of facet of being a peer-to-peer exchange of digital money?
I think, there's three things to see money like grow as a money. So basically it has to be a store of value, then a medium of exchange, and then a unit of account. Bitcoin's done very, very well with the narrative and also just in its history as a store of value asset. I do think the medium of exchange comes next, but it takes time. You need you need two parties for that. You need someone that wants to send it, and you need another one to receive it. Where a store of value, you, Dom, or we can just save money. Like, hey, I'm Chris Alamo. I take my free cash flows, I convert it from dollars, or I do work in Bitcoin and I accept it and I hold it. That only needs one counterparty in order to do that. Where with a medium of exchange, it requires two counterparties. So a lot of times I have a good, and like Dom, you and we'll go out, I'll get food when we're in California, and then I'll pay for it. And then, hey, dude, can you zap me some sats for this? Where like that's two parties that are willing to do that. But necessarily the establishment where we got food, either I put it on my credit card or something like that, they may not want the Bitcoin. So you kind of have to find two willing counterparties to do that. I do think that there's a lot of hurdles in terms of tax as well. Like you can walk into a bar and you pay with cash or a credit card or a debit card, and there's no tax, like, so to speak, on using the money or tax to use your money. Where Bitcoin, if you use it, you have to track the transaction, you have to report on that. Like I said, so I think there are a lot of hurdles in terms of other things restricting people from using it.
Yeah, I agree fully. Some great points there. I will just add one thing, Alamo, that I do believe long before we're using Bitcoin at Starbucks and stores, which some of them do it already, we need to see that peer-to-peer exchange of value after the store of value narrative kind of reaches its acceptance or capitulation phase. And by that, I mean, hey, you may sell me your motorcycle and I may say, great, that looks great, I want to buy it. And you say, hey, I'm only taking Bitcoin. Or you may sell your motorcycle and say, hey, I'll sell you this for $20,000 or the equivalent of, $15,000 in Bitcoin because I'd prefer having that. I think those two things have to happen on a larger scale before we get to the final boss of Bitcoin as a payment where, the network and the technology start to break down what is the walled garden of point of sale systems and credit card dominance and those kind of things. So
I'm going to add one more point real quick. I know we're at the time here, but I know Parker Lewis has this great quote working at Zapright. So tying this back into the clip, him at Zapright, they always say there's the Bitcoin price. So the normal price of what it should be. You using the motorcycle example, it's 15,000 if you pay in Bitcoin, or there's a 33% tax or fee if you pay in fiat. Meaning like, hey, it's 15,000 if you pay in Bitcoin, or there's 33 more expensive for cash, which I will take reluctantly, but I'm fining you for it, so to speak. So there's the market rate, and then there's the market rate on top of that with a fee, basically. So I know that they incentivize that at Zapright. Instead of a discount for using Bitcoin, saying it's worth less, saying it's more expensive to use fiat. But I think that's just kind of a mentality switch.
Yeah, and I mean, look, as much as inflation has hit the dollar and they say, the dollar's kind of having some turbulence, it's the most stable thing around. But for other folks with currency, that's a real thing. If you go to a place that has a currency that is being just wrecked by the government, that's a real thing where they are going to say, fine, I'll take our currency that's getting wrecked and devalued, but it's going to be a premium on cost because I need to go find a way to offload this. And I may take a loss on my end between here and going to offload this or purchase the next thing. So yeah, that's super interesting. We are going to, despite huge numbers of call-ins and emails for the self-custody tip of the week, we've reached our time. We are going to save that for the next episode where we're going to talk about Bitcoin nodes. But that is it for today. Tons of stuff from the prediction out of MIT to the turmoil in pension funds and some great insights from Parker. Of course, Alamo, always enjoy your insights and well-balanced view on Bitcoin and all things Bitcoin and money. For the workers at home, if you use Bitcoin for anything, use it to learn about money. It's one of Bitcoin's most valuable facets. And if you are going to trade your time for money, make sure your money holds up over time. That is all for Proof of Workforce Live. Chris and folks watching, we will see you very soon.
Have a good one, everyone. Peace.